What is going on, everyone? It is David Ramsden-Wood here for the Primary Vision pregame show with Mark Rossano. As always, Mark, how are you today?
Going pretty well. Just looking at the world at large, what is coming to market from a crude level. Looking at the 7-year auction, all the fun things as we get COVID ripping through Asia once again. A lot of things to consider as we look forward into a pretty much lackluster OPEC meeting.
So let's start with OPEC, the meeting this week. Rumor is there will be no change. We're still seeing cases spike in India. Questions about that. Do you agree with that assessment on OPEC? And what do you think about oil coming to market in the very near term?
So right now they've actually officially downgraded it again. Before it was rumored, then they were going to do it, then they're going to meet. Now it's officially set for June 1st, so there will be no minister meeting this month. And it's kind of what we were expecting and what we talked about last week, that, look, April's not going to change, May's not going to change, and they're just going to get more cautious on what June looks like. And we've already started to see that. The Urals have already started to come to market. We just had another crossing that at another decrease of another 10 cents, so it crossed at a 280 discount, which is a problem. And we're starting to see some of these headwinds as less and less crude is going into Asia. So we're back to a 6-month low for shipments into the Asian continent, and it's all really driven by India. So India is really taking it on the chin. When you look at what the refiners are doing, what the demand is doing, that's where we're going to continue to see those headwinds, which I think is going to become a bigger topic if this progresses through May, because it's just that's what June's going to look like in terms of where is demand for crude.
So how much, for listeners, how much does India consume on a daily basis, just in terms of the 100 million barrel a day potential demand? What percentage of that is India with their roughly 1.2 billion people?
Yeah, I mean, depending on the time period, it can be anywhere between 7 and 8 million barrels a day, with more to come. Based on what the projections were for at least 2021 into 2022.
So let's talk a little bit about COVID, because we're starting to see, as I've seen, we're about 95 million Americans are fully vaccinated. Another 45 million or so have received their first dose. And we've seen the 7-day average, which peaked April 13th at about 3.4 million, down to 2.7. And I would imagine slated to fall tremendously. The U.S. government has already said the AstraZeneca vaccine that we have, we're happy to ship it to the world, which is kind of funny because that's the one that has all the clotting news. We're going to restart the Johnson & Johnson vaccine, maybe. But it seems like the U.S. is going to have 200 to 400 million extra doses. Are they going to send those to India? Are they going to China? Or are they going to Canada? What do you think comes of all of this in the next month? And does it change the trajectory at all of the COVID pace around the world?
I think it's going to, we're going to definitely use this as a certain amount of diplomacy. So I think you're going to start to see that go into India, some of the emerging markets. When you look at, some could go to Canada. They've been working on some of their own deals. So I don't see it going too much north. I think that's really going to start going into the broader market. China's unlikely, just because they've actually been using this diplomacy pretty aggressively, that they're essentially half and half when you look at what has been maintained within the country and what has been exported, and we're only at about 1% to 2% of exports. So I think that that's really going to start to accelerate. And in terms of changing the pace or the direction, it's unlikely in the near term, just because you're seeing a lot of hospitals, specifically infrastructure in India, getting overrun. The question will be, how fast can we get them to some of the other markets like South Korea, Japan, where we continue to see increases in COVID cases. Japan's going into another 4 states are entering into an emergency for the next 10 days. And I think we need to start to see those places get their vaccines ramping up quickly in order to stem the tide a bit and start to see some of the economic growth, especially out of the Asian
So
continent.
we'll close on COVID, but I wanted to pivot just briefly and talk about unemployment. One of the things that perhaps some of our listeners have seen and heard from their peers, I certainly know restaurant owners, and as Denver gears up on May 16th is what they're being told that there will be no restrictions, they're really struggling to hire staff. And the primary reason being given is that they're making more on unemployment. We're seeing it in Uber, which is combined with the fact that rental car companies saw a very strong used car market, sold a lot of their fleet, and now in cities around the country, we have $250, $300 a day rental car rates, which is leading to huge surge pricing on Uber and just not enough drivers. We talk about the great reopening, but it seems like no one wants to work, which is exacerbated by the free money parachuting out of the Federal Reserve and the administration. What do you make of that? What do we see in the numbers of unemployment, and how big a hiccup is this going to be?
I think the hiccup is going to be quite large. And one of the things that we said from the beginning when we looked at when we had that big drop off in March was, and by March, I mean March of 2020, we were concerned in 2019 because you saw some slowdowns, you saw a lot of bloated companies, you saw debt as a big issue, and companies were talking about reorganization, slimming down. What did COVID give but a fantastic cover where you didn't need an HR portfolio on someone to say, look, this is why I'm letting them go. This is why I'm shutting down this facility. This is why I'm shutting down this unit. Everyone just said shrug emoji, COVID, and that just became the end of it all. So now you had a situation where, I use the example that if a company had 100 people that were furloughed, we expected 20 to 30 to come back quickly. They were going to come back after we got through the bottom of this. Then over the course of the rest of 2020, we were going to get another 20 to 30. So right now, you're at about 50 people hired back by the end of 2020. Now, we only really see 20 to 25 additional people coming back into that specific company. Everyone's looking to run a little bit leaner. Everyone's looking to keep labor costs low, as we do have inflation all over the place. But it's also complicated with, well, how much am I getting paid in pandemic insurance? What is my benefits? And that's what we're starting to see. You're starting to see people come off of short term. You're getting less new filings, but you're seeing this residual hold on to those extended benefits. So you have, to your point, you're going to have those people that are like, look, I'm making way more money sitting at home collecting these different paychecks. I'm going to continue to do that until they say no more. The other side of the equation is, well, what if I'm never going back into that industry or that company? Now you have this bifurcation of skill set versus job openings. And when we look at the beverage curve, job openings never really fell along the normal moves that we typically see during recessions. Instead, it kind of flatlined, and we had this unemployment blowout, but the job openings never really went to where they should be. So now we're back up. Job openings are there, but there's this mismatch of, well, how much are you going to pay me? And do I have the right skills? Because the employer's looking there and saying, I know there's a ton of people that are out of work. I'm going to wait for the right candidate that has the right skill set. And they're not willing to move. And the other individuals are like, well, you can't hire, so I'm not going to cut my day rate for you. And this is where we continue to see this back and forth that is going to keep things elevated for at least the next quarter.
So, Mark,
or
do you
so.
think it's possible that this is part of the Democratic plan across the country to raise wages without actually raising wages, where they've created this situation where the government is creating benefits being paid with extended programs, and in order to encourage workers to come back to some of the jobs they were at where arguably they didn't have a living wage, and that was certainly the argument about $15 minimum wage, now all of a sudden employers are going to have to dramatically raise prices on their food service offerings in order to attract wait staff back. Is this part of the plan, or do you think ultimately once all the programs expire, we're going to see a level of normalization that will result in continued inflation but wage deflation, given that there are, as you said, less jobs available for people? Where does this land?
I think it's a mixture of not just Democratic or Republican, but just complete mismanagement on the government. And then when we go down to the central bank level, where everyone was like, "Oh, we have all of this money. We're the reserve currency of the world. We can print all these dollars, and that won't have any residual impacts." Well, they're wrong. They will have residual impacts. We're seeing this with just the 7-year auction today. Interest rates are going up, and as we continue to paper the town with just this rising number of not only debt that we're rolling, but then new issuance, the cost of these programs are just unsustainable. We have to start getting real about what is our budget really going to look like, and can we really generate that kind of GDP growth, to offset it? And the resounding answer is no. We're coming into a very difficult period of time, and we're going to have to start to pull back on some of these benefits. So I think once they expire, you're just going to see them expire. There might be some residual at a much reduced rate to give people a little bit of cushion to make sure that they go back. But you're going to need to see people starting to go back, because the debt bubble is just going to continue to grow at the Fed level.
Let's pivot to Tesla. Tesla came out with their Q1 earnings yesterday. Top line, just amazing revenue growth from last first quarter, 74% growth. And they continue to make all of their profit from the sale of Bitcoin and EV credits. What do you make of it? And how is the market not trading this thing down 80%?
I think the biggest issue is it is a cult stock. We all know that. And people still have this long-term vision for what Tesla is going to become. But when you look at where all of that money was created, it was at the car company. But yet they tell me it's not a car company. Well, it is. And you can clearly see that they're not even a very good car company, because they only make money from the credits that are set to expire, at least for Tesla, mostly in 2022. So when those go away, then what? When you look at what they've earned, it was $101 million from some of the sales of their Bitcoin, and it was about $513 million from EV credits. So we're looking at something where, when we take all this out, they lost money again. And when does that going to stop? Now, when you pivot to what they're doing at Solar City, they continue to lose money. They're not generating any real growth from the solar side, from the storage side. So where are we going to sit, especially when you start looking at what VW or Volkswagen has done, when you just look at the market share that they've taken, and what Tesla did in 10 years, Volkswagen did in 1. And that's the problem when you have now a hard pivot and real dollars coming from companies that they make cars, and they're openly a car company coming at your car division.
It will be interesting. Well, one final closing thought. I want to talk about COVID because it is sort of back in the news, and a couple of interesting stats that I pulled up here in terms of the post-vaccine world. As demand continues to fall, there was a study that was released from data in the end of March that said half of Americans under 25 are nervous about the prospect of social interaction post. So in the lowest demographic of age risk, 50% feel nervous or very nervous about resuming social interaction. In another point, 48% of adults said that even post-vaccination, they are still very concerned about COVID. I raised that point because when you think about the narrative around COVID, and in particular, we're seeing JP Morgan says they're expecting employees come back in June. We're seeing the great reopening, and employers are not really keen on keeping the work from home, and yet it has become a benefit to employees, especially white-collar employees that discover they like walking their dogs during the day. How much of this COVID fear is just based on the fact that if they're not scared of it, they have to go back to the way their life was before COVID? And a lot of people really didn't like going to work. What do you say to that?
So I think the fear is going to be that residual, and that's why whenever we go through the shows, we always like to separate. There's what the government's going to tell you to do, and then there's what the consumer is going to do. And the consumer is going to take time. Like I use the example, given it's an extreme. My grandmother, when she would tell me at the age of 5, go downstairs and get the pizza dough from the coffee can, because whose Italian grandmother didn't have coffee cans all over the basement, and I'd have to dig through 3 before I found the pizza dough, and the other 2 were filled with cash. And I'd go upstairs, I was like, Grandma, why is there cash in the coffee can? And she's like, well, we can't trust the banks. She was 80, and this was in the 90s, and the Great Depression was in the 30s. So when you just look at some of the residual that's going to interact, it's going to take time to get people back and comfortable, learning how to interact. And let's be fair, the age group that you described were already socially awkward because of they'd rather communicate on text than to sit across from someone and have a conversation. So there's already some of that's been baked in that will take time to recover. On the other side, when you just look at this residual of coming back, the reopening, I just think that's going to take time. And when you look at JP Morgan, Exxon, and then compare it with other companies that have started to adopt more of the flexible schedule, I think it's going to be this marriage of what is flexible versus not, because they say all employees, but it's still on a rolling basis, and it's still going to be within a certain cap. And I think they're trying to test of what does a flexible schedule look like without saying it. And I think that's going to become more of the norm, because like you said, they like having that midweek off. Like maybe they want to walk their dog on a Wednesday, and they'll go to work Monday, Tuesday, have off Wednesday, Thursday, then close out strong on Friday, or some metric that's going to happen. But I think that's going to become a more of a normal than not, because I think the full work from home is going to be tough. How do you impress management? How do you move up the ranks? Because that has been identified. I think there was another article talking about 86% of workers, want that engagement with their, the C-suite and management in general. So I think to maintain culture and some of that growth, you're going to need that in person, but it's going to be on a flexible basis.
No doubt those people who came out of World War II and started their careers in 1950 and worked until 1985 or so are rolling in their grave as they hear about Wednesdays and Thursdays off to walk the dog. We will chat about that next week. Until next time, I am David Ramson Wood for Mark Rossano. We thank you for joining us. Tune in for all the segments from the Primary Vision show on the economy, on OPEC, on EIA, and you can follow those and get those on Twitter or on LinkedIn. Until next time, have a great day. Thanks for joining us.
Thank you. All right.